This is Asia Trade. I'm Shery in Tokyo.
And I'm Paul Allen in Sydney. The top stories this hour. Asian stocks set to extend losses from Wall Street on signs of a cooling US labour market and stretched tech valuations. Bonds rallying on bets the Fed will cut rates. Data out today is set to show China's export growth slowing, with US trade falling sharply ahead of the trade truce. And Tesla jumps some late trade as shareholders approve Elon Musk's $1 trillion pay package, securing his future with the EV pioneer. Okay, we've just started for open for trade here in Australia for this Friday, final trading day of the week. We are currently a little bit softer, as you might anticipate from the lead-in that we had from US stocks. The ASX off by about 1/5% at the moment. A couple of stocks to watch as we get underway here. We're taking a look at shares of Macquarie, one of the big investment banks here in Australia. A little bit softer at the moment, off by about a bit more than 4%. This is after first half net income missed estimates, coming in at around about $1.1 billion US, a dividend of $2.80. That was less than expected as well. The market was looking for $3.03 there. Macquarie's share buyback extended by 12 months. So the stock falling pretty steeply at the moment, off by about 4%. Also keeping an eye on shares of Qantas as well. We've got the airline currently off by about 2.3% after Qantas cut its full year capacity forecast. This is coming out of the CEO's speech at the AGM. It does see fuel costs a little bit more heading into the next year, but trading conditions in line with those outlined in the August outlook. Elsewhere, we've got Nikkei futures pretty much flat at the moment. The yen strengthening a little, but pretty weak from what we've come accustomed to. It's 153 at the moment, Shery. Oh, actually, one more thing to mention. That's OCBC earnings, also out of Singapore for the third quarter. Net income beating estimates quite healthily, very close to 2 billion Singaporean dollars, coming in at 1.98 billion. The estimate was for 1.78. A few other details from OCBC. Credit costs about 20 basis points. The bank saying the external environment remains complex. Shery.
Yeah, interesting that they're mentioning the allowances largely coming from impaired assets. And it's really that concern about also the U.S. economy, where we had some volatility on the overnight session from Wall Street. We continue to see more indicators about a cooling labor market. Of course, we still have a lack of data right now because of the ongoing U.S. government shutdown. So we had Treasury yields under pressure, but still within a range. But when it came to those stretched valuations with tech stocks, they led the declines again. So we had that resumption of losses. You can see right there on the right side that U.S. job cuts have surged for the month of October, according to Challenger data, showing that 153,000 job cuts were announced last month. This is the most for the month of October in more than 2 decades, led by the tech and warehousing sectors of the U.S. economy. Despite the fact that we're seeing these pressures on the labor market, though, the Fed continues to contend between this debate on whether to focus on inflation or the cooling jobs market. Take a listen to what the Cleveland Fed president is focusing on.
I remain concerned about high inflation and believe policy should be leaning against it. After last week's meeting, I see monetary policy as barely restrictive, if at all, and it's not obvious to me that monetary policy should do more at this time.
Let's bring in Sylvia Jablonski to discuss all this, CEO and CIO at Defiance ETFs. Sylvia, great to have you with us. So we continue to hear these comments that perhaps we should continue to focus on inflation. So if you don't have the Fed cutting as markets had expected, as fast as markets had expected, and then you have these stretched valuations, are we just headed for a correction inevitably right now?
Hi, Shery. I think it's a great question. There's a couple of pieces to this. So I think that, if you look at the market, it's essentially just been straight up, right? In a lot of these sectors that are now experiencing the pullback. And so I think that investors were waiting for some sort of pullback, some sort of reason for a pullback. And, lo and behold, we got it. But in terms of the Fed and what the Fed's going to do, I thought that Fed Chair Powell was pretty clear on his mandate and his interest in what was going on with the labor market, and these weaker numbers, I think, could propel him to, lean more towards the cut than against the cut. Had this been a good number, I probably would have said that I don't know that we'll get a third cut. to come this year. But I think, the odds are kind of in favor of that. And in terms of earnings, 80% of companies have beat on the top and bottom line. Some of the outlooks have been softer than the street expected, but these earnings are very, very good. And so in terms of stretched valuations, if the earnings data is feeding into and justifying the valuations, then, you're kind of okay there. It's just a matter of, what does the future hold for some of these stocks?
Yeah, do you still pile into those AI bets, or do you just stand back a little bit and let the froth sort of cool down from here? Where do you hedge in an environment where valuations are this high?
Yeah, it's a great question. I think it depends on the investor, and it depends on his or her portfolio. For investors that have portfolios that are highly skewed towards the Mag 7, they might want to look at something like an X Mag and get S&P exposure to the other names essentially. But I also think that it's worth expanding into tech. So yes, I am bullish on AI and the future of AI and quantum and supercomputing. But like anyone else, I see risk there, and I have seen that these names have run up. And so I try to think about what would be the second and third derivative of AI. And in my mind, and what's kind of playing out in terms of stock pricing now, is AI infrastructure and power. And so if you look at some of these power companies, they're really getting a lot of volume. They're getting a lot of attention and performance as well, because I think that, even if you get some cuts in spending from the classic chip makers, this AI powered infrastructure has to be built out to support what we're doing with data centers, cloud, Bitcoin mining, and things like this. And so it's just a matter of picking your spots. But I still like these sectors of AI and tech.
Yeah, the AI story's got a catch-22 angle to it in some ways, do you think, Sylvia? Because you mentioned a moment ago that so long as earnings are okay, the market's going to be okay, and there's a lot of excitement around AI at the moment. But at the same time, those weak jobs numbers, those redundancies that we heard about today, a lot of the blame for that is being parked at the door of AI. So what I'm saying here is that if there's weaker spending, tougher times ahead, is that going to impact on earnings?
Yeah, I think that some of these jobs get repurposed, and I think that AI will repurpose a lot of things, right? And so in terms of creating efficiencies and economies of scale at some of these companies, I think AI still has a lot of work to do in terms of, filtering down to perhaps financials, pharmaceuticals, healthcare, aerospace, and defense. You're going to see that play out in the earnings of those companies over time. I think, though, in terms of the job numbers, you're talking about tech companies that did some layoffs and replaced some of these jobs with AI. And of course, that impacts the economy. But, there are a lot of different types of, positions that these people can essentially feed into to support the growth of AI and embedding AI into the whole ecosystem. And then, there's all these different types of technologies that are still building out, whether it's in Bitcoin mining, whether it's in supercomputing and quantum computing, whether it's in aerospace and defense and AI and, kind of drones and unmanned machines and things like this. There's so much to AI. And I think that some of these tech employees could go to other places and have those spots filled to make up the numbers essentially. But that takes time. And the point is taken. It does take time.
Okay, so there's a case for the rally to continue, sure. But where are the risks that you're seeing at the moment?
I think, you started off the segment with a lot of them, right? I think if earnings, we are in this Goldilocks situation. We had the soft landing. So anything that isn't meeting exactly what the street expected seems to be setting the market back quite a lot. On top of that, this poor jobs numbers. So I think anything out of the ordinary could lead to some choppiness. However, the market, when you have a 15 to 17% move ahead of these pullbacks here, the market tends to be up another 5% in these types of years. And so I think pullbacks are healthy. They're a normal part of investing. For now, that's what it looks like we have here. Remains to be seen what happens in the next month or two. So I think, I do think corporate earnings are pretty good. The consumer remains stable. And there is still a case for a bull market this year.
All right, Sylvia Jablonski, CEO at Defiance ETFs. Thanks, as always, for joining us with your analysis. Now, I mentioned a couple of stocks here in Australia a few minutes ago. Let's just check in on them. Macquarie Bank, the investment bank, slipping in early trade. We're off about 3.8% at the moment. Now, this is after the bank came out with first half earnings that unimpressed the market. A miss there on the headline number. Net income $1.1 billion, dividend of $2.80. That was less than expected as well. The market was looking for $3.03. The buyback for Macquarie, though, has been extended by 12 12 months, but we're seeing the bank losing a bit of ground at the moment. The other one I want to mention is Qantas, the airline having its AGM today. A few remarks there from the leadership. Qantas going to be cutting its capacity forecast, sees a 4% increase in the coming year, not 5% as previously stated. It's also saying fuel costs are going to be a little bit higher, and also trading conditions, though, broadly in line with the outlook announced back in August, but Qantas shares also slipping a little bit more than 2.5% at the moment. Still to come on the Asia trade, we're going to talk bond market strategies with Pendal Group and why private credit defaults are rocking sentiment. Also, ahead of the COP30 climate talks, Helical Fusion is going to be joining us to talk about Japan's clean energy strategy. Much more ahead. This is Bloomberg.
China is reporting trade data later today, with both exports and imports expected to grow at a much slower pace on year compared to the previous month. Let's bring in our China correspondent, Min Min Lo. Min Min, it seems that strong upside surprise that we got from last month's data may not be sustainable.
Yeah, that's right. And there are a number of reasons for this. Of course, you have the October Golden Week holiday that is a seasonal disruption to those export data. But also last year, we had a very, very strong base. It was about the highest print that we got in 2 years, 12.6% last October. If you recall, that was when a lot of front loading had began because of anticipation that President Trump might be elected. And so that really weighed on the data this time round. And you add to that, there has already been many months of front loading, and it seems like overseas orders are taking a bit of a break as we were looking towards that Xi and Trump meeting last month, and a bit of relief that is maybe coming through from the commitments from both sides to dial down tension. So you can see exports expected to have grown less than 3% on month in October. Imports as well expected to have grown about 2.7%, and this continues to reflect that weak domestic demand, right? One of the factors our Bloomberg economics team was saying that there is a widening income gap in China, and that continues to be a barrier. And even as the government has been trying to do more to boost domestic consumption, we still see that sentiment remains very weak at this point.
How about going forward, though, Min Min? Because China's Ministry of Commerce is saying they're willing to implement the U.S. trade deal. What else have they got to say?
They did not elaborate very much, aside from saying that they were willing to implement the trade deal. They did not explain the difference that we have seen between the U.S. and Chinese statements so far. Of course, the White House had issued a fact sheet that was a bit more detailed. But so far, we have seen China already taking certain actions, right, like removing those retaliatory tariffs on U.S. agricultural goods, removing a number of U.S. companies from its unreliable entity list, and this as the U.S. also lifted the 10% fentanyl-related tariffs on Chinese goods. So it seems like both sides had been pretty swift in implementing the actions following the U.S.-China trade talk. But elsewhere, though, with the EU, the Commerce Ministry did mention that they are open to discussing an investment pact with the EU. That was something that was put on ice back in 2021 because of accusations of China's human rights records. But it looks like China is now open to restarting those talks with the EU as well.
All right, Bloomberg's China correspondent Min Min Lo there. Well, U.S.-China Business Council President Sean Stein says there's cautious optimism among American and Chinese firms after Presidents Trump and Xi struck their trade truce a week ago. He spoke to us on the sidelines of the China International Import Expo in Shanghai.
It has absolutely been bogged down. And American companies have been very much on tenterhooks, wondering which way things are going to go. What I think is interesting is after Korea, the Chinese government has already tried to send out signals that we welcome American business and we want you to be here. I mean, case in point, we're at their giant, import expo. We have more American companies here than at probably any other trade show in the world. And last night, the Chinese premier comes, and who does he visit? He visits 3 American medical companies, sending a really strong message that, hey, we value you and we value your investment. So the Chinese side is trying to reassure American business. But American business, while they see the deal that happened in Korea as the best possible outcome, there's a question about, is it going to last?
Right. How long will it last?
Well, we've seen this movie before, right? Yeah. 2 days after Geneva. Geneva lasted 48 hours before it melted down. And I think Madrid lasted about 10 days before we started to have real problems. And so while there's hope that this time it'll continue, there's still going to be a lot of guarded, cautious optimism, at least until April.
Not asking you to take a political position here, but do you think in Washington they underestimated China's position and levers of strength that they could possibly employ going into this trade war?
I think there were 2 problems. I think one problem is I think the United States may have overestimated its leverage and how worried China would be about U.S. tariffs. And I think they underestimated China's counter leverage.
Right.
But at the same time, both sides have the ability to do enormous damage to the other's economy through export controls and other measures. And I do think that both sides have sort of looked over the abyss and said, maybe that's not where we want to go. And so both sides have realized, yeah, now's the time we can pull back. The question is, can we stay pulled back? Or are we going to get into another escalatory spiral?
What are you seeing internally in America against the backdrop of these national policies? Are you tangibly seeing regional blocs looking for their avenues into China? I'm not necessarily saying trade deals from the Pacific Northwest. Say, for example, Washington state officials are here, Oregon state officials are here. Look to what's happening in the Midwest with the, those soybean farmers maybe feeling they're not getting their voice heard. Are you seeing sort of regional blocs talking to the Chinese officials, talking to the Chinese companies, and trying to get some sort of favorable deals for themselves?
Okay, let's not name names, but I'm seeing some nervous governors. 800,000 jobs depended on trade with China. And those jobs are starting to go away because U.S. exports to China and U.S. exports to other regions are going away because of high tariffs in the United States. And so I'm hearing about nervous governors who are asking us, how long is this going to go on and where is the light at the end of the tunnel? I'm hearing it from members of Congress on both sides. So I think that, yes, we're not at the point where I think we're seeing regional blocs, but I do think we're seeing governors starting to think about how can I continue and protect the jobs that we have that are tied to exports to China.
Last question for you on the high tech. Obviously, Donald Trump was talking about possibly putting Blackwell chips on the table. I think maybe his more national security hawks in D.C. convinced him otherwise. But how do you see China's leverage increase tremendously through the DeepSeek moment and its confidence in AI to the point where they don't necessarily need that chip?
I think you hit that on the nose. And that is, my job was negotiating with China for a number of years when I was at the State Department. And you would get a long list of issues that were unresolved. And the issue wasn't, say, if we had 15 issues that were unresolved, the issue wasn't to resolve those 15 issues. The issue was to find the 3 they really cared about. The rest were bones that they would throw at us to chew on. I think that right now, Chinese companies, they want access to chips. The Chinese government, not so much. And so I think this is one of the bones they've given us to chew on, where do I think it's good for the U.S. economy to sell more chips here? Absolutely. Do I think this is keeping China up at night, that they're not getting Blackwell chips? Yeah, probably not. And the most important thing is the way they talk about it. When I talk to Chinese businesses, entrepreneurs, academics, scholars, and most importantly, people in the government, and if you ask the question, who's winning on AI, they give this look like, what does this mean? What is this winning of which you speak? And they don't see it in those terms. What they see is, they see not a race to AGI. They see a race to deploy AI into every business, every school, and every sector of the economy. And what I see are companies, whether they're Chinese or foreign, racing and pushing AI out into every aspect of their business operation. And I think in the minds of the Chinese, that's the goal with AI, is to push it out and drive efficiency.
U.S.-China Business Council President Sean Stein speaking with our chief North Asia correspondent Stephen Engel in Shanghai. We have more ahead on the Asia trade. This is Bloomberg.
Let's take a look at how Tesla stock is tracking after hours. Kind of flat at the moment, not a lot of reaction despite shareholders approving Well, the largest payout ever awarded to a corporate leader. $1 trillion compensation package. 75% of the votes cast in favour of that plan. We've had some other remarks from Elon Musk as well, saying, well, Tesla's going to reveal a Roadster 2 in early April 2026. Production to begin 12 to 18 months later. So sports car fans rejoice. That's on the way, apparently. Tesla has some interesting timelines sometimes. Elon Musk saying that maybe SpaceX should also become a public company. He says he wants Tesla shareholders to be able to participate in SpaceX as well. But let's get a little bit more on Tesla's outlook now. Get over to Bloomberg Tech co-anchor Ed Ludlow joins us now from San Francisco. So Ed, $1 trillion, that's very nice. He's going to have to work for it though, isn't he? What sort of targets are in place for him to get this payday?
Yeah, it's sat against very real mandatory milestones, operational and financial, deliver 20 million vehicles, hit 10 million full self-driving subscriptions. The 75% vote in favour of the pay package, very interesting. We'll have to sort of post-mortem and tabulate how much of the index and passive fund shareholder base voted in favour of it. But what I'd note is that on stage, Musk kind of took a victory lap and talked about the company's future, but did not sort of directly address the vote itself or the pay itself. So I'm sure we'll hear more.
And getting to become the first trillionaire ever hasn't been easy, right? Especially this year where his wealth has been on a roller coaster ride. Rich Go, one of our favorite functions here on Bloomberg, showing $450 billion for earlier in the year. Then that was down because of those political pressures and criticism. How is he going to get Tesla's market value up, not only his own wealth?
Yeah, so one of the goals that the board has set is for him to get Tesla's market cap to $8.5 trillion and for it to hit adjusted earnings of $400 billion, which is quite a financial feat. And we've always talked about this headline, a $1 trillion pay package. But really, for Elon Musk, this was about having more voting power and voting control. And for those institutional investors that voted no, they were worried about concentration of voting power that he had and dilution for them. In the end, voters have overwhelmingly come out, 75% of them or more, and said, we're happy to hand over more control to Elon Musk and keep him in the driver's seat to realize these longer term goals in robotics and autonomous driving. But that was what really was at issue here, the voting power, not necessarily how much money he makes in tranches over a 10-year period.
Ed, some of these timelines, as I alluded to a little bit earlier, when it comes to Tesla and Elon Musk, are pretty rubbery. They remind me of an Australian tradesperson in many respects, but Musk himself says he specialises in making the impossible merely late. When are we going to see some of these innovations?
Yeah, Elon Musk's skill has always been to keep investors looking to the horizon, right, to the future. The pieces of news were, as you pointed out, that Roadster will be unveiled in April of next year and production of it will follow a year later. He has also talked about growth targets and about actually across 2026, another 50% annualized growth, which would mean Tesla starts building kind of 2.6 to 3 million vehicles per year. That's something that they'll have to do if they're to hit, Musk is to hit the board's mandatory goal of delivering 20 million vehicles to consumers over the 10-year terms of the pay plan. So that's kind of in line, but you are absolutely right. Timelines are not Elon Musk's strong suit, but as we always point out in the context of Tesla and his other companies, they often get there in the end.
Bloomberg Tech co-anchor Ed Ludlow there with the latest on Tesla and, of course, Elon Musk's pay package, as well as we continue to watch that business, especially across Asia, and that pressure perhaps on China on that very, very competitive EV space. More ahead on the Asia trade. This is Bloomberg.
The bond market is suggesting much higher R-stars, but I would discount that a bit because they've tended not to be reliable. And importantly, and this is where I just remind us, even if R-star is higher, it doesn't mean the concerns about the lower bound should completely vanish from our kind of thinking.
New York Fed President John Williams talking about the R-star, the point where monetary policy is considered neutral. Of course, we continue to get Fed speak on where the economy is and whether to focus on inflation or the cooling job market. There really isn't much data point to go by given the U.S. government shutdown, but we're seeing some private indicators showing that the labor market might be softening. So Treasury yields fell in the overnight session, but they stayed within a recent range. We're going by, as I said, second-tier data, not to mention technicals as well. Money markets implying a better than 60% chance of a Fed cut next month. But it's really interesting, Paul, that we continue to see this borrowing spree. Global bond sales now have soared to a record this year.
Yeah, let's get a little more on this with our next guest. Amy Shear-Patrick, Head of Income Strategies at Pendal Group, joins us now. Amy, thanks so much for coming in today. It's always good to see you.
Hi, Paul.
You heard the remarks from John Williams there a moment ago about where the neutral rate is versus where the bond market seems to think it is. What's your view on that?
I don't spend a lot of time guessing where the neutral rate is. And, you know, at the end of the day, I think these things are highly academic exercises that don't bear a lot of fruit in the moment. But I think what you are seeing with the US right now, it is terribly difficult without a lot of data. But on the job side, I actually go by the Indeed data as a bit of a nowcast as to, you know, the amount of tension or slack that there is in the labour market. All indications seem to say that we're pretty much at full employment. So this is the tricky part, right? We're at full employment. Inflation is stickier than we would like it to be, definitely higher than where the Fed would like it to be. And that's why we're throwing off so much tension in the bond markets right now. So our stock, you know, it could be where the Fed says it is. It could be lower like it was prior to COVID. That does not affect the way that, you know, I approach the next trade or the next investment decision. But I do think that there are some early signs that the labour market demand side is softening, but not to a point where I would worry that you need to be putting in a lot more cuts into the market.
Yeah, we did see some evidence of that today, even in this data-poor environment. Job cuts in the US, I think the worst we've seen since we exited the pandemic. So where does that leave us in terms of a December rate cut? Are we at in coin toss territory here, or do you see the Fed just staying on hold?
I see a coin toss sort of scenario. I'm more, you know, if you'd have asked me about a month ago, I would have said, for the nature of where the US economy is right now, you've got inflation that's frustratingly still above where the Fed would like to see it. You've got the labour markets starting to soften a little bit on the demand side, but on the whole, it's being balanced by the fact that these immigration policies are also shrinking labour supply. So in terms of overall labour market tightness, it's there or thereabouts. And therefore, why are we pricing in so many cuts into the US? Now, Australia was the first mover in all of this, obviously. The narrative in Australia is very much the RBA's cutting cycle may well be done. And in fact, their next move could be a hike. I just think the US needs to spend more time probably moving in the direction of the way that the Australian narrative has gone.
Amy, good to have you with us. It was really interesting to hear at the Global Credit Forum that we held here at Bloomberg in Japan just this week that when you look at credit spreads, people are talking about how tight they are, but that they're actually masking the fact that we are really counting the fiscal risk premium, and that you shouldn't compare that to the fact that we don't have any risk around, that you should actually look at swap spreads to give you a better understanding of where real risk is in the economy. Do you see that the bubbling of potentially distress coming up in the global economy?
I don't see it as distress. I see it as, you know, just signs of typical through the cycle types of volatility. And one thing I would say about credit spreads is I hear a lot these days that credit spreads are at their, you know, cycle tights, and therefore, you know, how much more upside can you really get for credit? But I continue to remind a lot of the clients that I speak to that, you know, even though credit and equities, they move in the same direction. So they go up together, they go down together. Credit ultimately is parceled in the shape of a bond. And the shape of a bond as a buy to maturity holder is that your upside is capped, you get your par back in or your coupons along the way, and your downside is you could potentially lose everything. So credit spreads naturally do spend a lot of the cycle staying at or close to the tights of the cycle. Within credit, though, there are different tiers. And I think just because investment grade and even high yield bond spreads are tight doesn't mean that there aren't problems in credit overall. And I do think that some of the defaults that you've been hearing about, especially out of US credit, are signs that, you know, at the junkier end of the credit spectrum, that probably does warrant some worry. I don't particularly think that this is systemic, though.
Yeah, of course, we have seen Forest Brands Tricolor as well. But what about parts of the market that we don't have that much visibility in? I mean, we continue to talk about the exponential growth of private markets and private credit in particular.
I think Bloomberg data themselves, you've done a lot of great work in terms of showing us, on a market level, how long it's now taking for, new tiers of capital going into private credit funds to get paid back on their initial investments, and that time horizon is lengthening and lengthening. Now, that could be due to several things. It could be due to deteriorating credit quality, but it could also just be that because spreads have tightened, rates are off their highs, it's just taking longer to get paid back in terms of the income that you earn on these investments as well. So one thing that I do always keep an eye on, though, in any market or in any type of sub-asset class where the growth is just so quick, and conceptually, you can understand in less liquid markets where there could be more alpha opportunity to be gained, but those alpha opportunities are likely finite. They're not infinite. And at the same time, it's met with a wall of cash going into that asset class. You're inevitably going to trip up on some kind of, chasing too much risk in order to fulfill investor return expectations. And, because of where we are in the credit cycle, because of where we are in the economic cycle, you're starting to see some of that surface. And I think within the US, it's understood that when you go into private credit, you're at the junkier end of credit, you're at the riskier end of credit, you are intentionally taking on a little bit of default risk in your portfolio. I think in other parts of the world, that same growth has happened, like in Australia, and that is probably slightly poorly understood.
Yeah, I mean, we are seeing a lot of cases here in Japan as well where the market continues to grow, where there needs to be more understanding of how private debt works. Let me ask you about these lofty expectations of what artificial intelligence can do, because we continue to talk about stretched valuations with these tech stocks. But the fact remains that a lot of these companies continue to borrow in the credit space in order to fund all of these investments. Could this be an upcoming risk that we're not really accounting for at the moment?
That is such a good point, and especially related to the last point I was talking about, in spaces like private credit, where suddenly it's been met with a lot of demand for those types of private credit returns, and the pool of opportunities isn't expanding that much. What often happens is that those managers of private credit funds, in order to look for the same sorts of returns, end up being quite concentrated in areas of risk that they didn't originally intend to be. For the US, AI-related borrowing or AI-related lending from a private debt perspective is probably going to be where that risk is, right? And the concern is, at what point does the equity market start to punish CapEx announcements in the AI space? And if all of that CapEx, or the majority of that CapEx in data centers, in new energy supply, is being funded in private credit, it's opaque. We're not really seeing how they're performing, and we won't know when the shoe drops until we hear the noise. In Australia, similarly, that expansion has been very much into construction lending, and the troubles that we're seeing in Australian private credit are very much related to that sector.
All right, Amy, thanks very much for joining us today. Amy Shear-Patrick, Head of Income Strategies at Pendal Group. Still to come, Helical Fusion is going to join us for the outlook of commercial nuclear fusion energy in Japan under the pro-nuclear stance of Prime Minister Takaya. This is Bloomberg. World leaders gathering for the COP30 summit in Brazil are lamenting the slow pace of efforts to combat climate change. UN Secretary General Antonio Guterres says the world is set to overshoot a key Paris Agreement goal of limiting warming to 1.5 degrees Celsius above pre-industrial levels. Guterres describes it as a moral failure and deadly negligence. It provides a challenging backdrop for COP30, which begins on Monday. Shery.
Right, Paul, turning to energy markets here in Japan, nuclear fusion startup Helical Fusion says it's completed a key performance test that could accelerate timelines for fusion power. With construction of a test facility underway, the company is betting this development puts it at the forefront of the race for clean energy dominance in a sector that's attracting billions in private capital. Joining us now is Helical Fusion CEO Takaya Taguchi. Takaya, great to have you here in the Tokyo studio.
Thank you so much.
So tell us a little bit about what you're doing, because I know that you just finished a $15 million funding round just in the summer. So you are trying to put forward this fusion reactor.
Yes, of course. The fusion is the energy of the sun. So the fusion energy is to create an artificial sun on the Earth, mainly for the power generation plant. And we have a spun out from the Japanese, National Institute for Fusion Science in Japan in 2021. And we are trying to implement the world's first commercial fusion power plant in the 2030s.
So how are you using the $50 million recently raised, and what are your goals and timeline?
Okay, so we are utilizing the fund raised, the fund mainly for the R&D to complete R&D with especially the engineering technologies like high temperature superconducting magnets, which is one of the components, core components for the commercial fusion reactors, and we will complete our R&D by 2030. And then we will move forward to the construction and operation of the first fusion power plant in the 2030s. So the first power generation will be the middle of 2030 or so.
Talking about R&D, I mean, this research has been going on for decades, but the commercialization has been difficult. So what makes you viable?
Yes, so there is over 60 years experience in Japan and all over the world regarding the fusion science and fusion development. And we are now focusing on the main two key components of the fusion reactors: the high temperature magnets, high temperature superconducting magnets, and the liquid metal blanket, which is core components to extract energy from the fusion reaction and convert energy to the heat to drive the turbine. So we are in the last 1 mile toward the commercialization.
Takaya, of course, the long-running joke with fusion energy is that it is always 30 years away. Do you feel that is no longer the case, that finally that this technology is on the cusp of being realized?
Sorry.
So Paul was asking that the joke is always that it's just a few years away. So do you believe that is in the cusp of realization when it comes to actually making money from it?
Yes, of course. So as you said, it took over 6 years so far. But we are now last 1 mile toward commercialization, and because we have already graduated from the scientific issues like plasma physics, thanks to the R&D in the national universities and national laboratory, and so we are sure that we can complete our preparation in 3 to 4 years. Yes.
In 3 to 4 years.
Yes.
How much interest is there then on investors getting into this field right now, and what are the potential partners that you're looking at?
Yes, there are a lot of investors in Japan and all over the world who are interested in the fusion technology and the commercialization of the fusion energy. And we have 20 to 30 investors in our companies, mainly from the Japanese corporates and the Japanese VCs. And the interest in the fusion technology is rapidly growing in Japan as well. So yes, we expect that lots of and more investors or more and more corporates will join us.
Tell us a little bit about the industry here in Japan, because we know that the new Prime Minister Taguchi has been an advocate of nuclear fusion. Are you going to see more backup from the government side, and what conversations are you having?
Yes, hopefully. And as you said, Ms. Takaichi, the new Prime Minister in Japan, is very supportive to accelerate fusion technology in Japan, here in Japan. And so the affected by the stream, the many Japanese corporates are very active in the fusion areas now. So yes, we expect the much more investors and the corporates will join us and accelerate industry in the fusion area.
Is the industry that you're looking at right now still domestic, or are you thinking about exports of the technology as well?
At the moment, they are developing technology domestically, but because there is some national security or export regulation in Japan and, of course, in the other countries. But once we complete our technology and realize the fusion energy, this could be used in of course, globally. Well.
Is there a timeline? And I know that national security and economic security these days are very important when it comes to this sector. So how are you viewing that?
Yes, so as we plan to complete our technology in the 2030s, so from the 2040s, the commercialization will be activated globally. Yes.
When it comes to national security again, how do you view that sort of balancing act?
Yeah. That's a very important point. And the key point is how to expand the business and protect the technology. Right? So the secret key is to integrate the commercial fusion reactor system itself, whole system of the fusion reactors, and how to operate such fusion technology. Right? So this is kind of not just the hard technology, but also the soft technology or engineering and integrated system, so that we can divide such hard or soft technology, and we can protect our technology or system integration by ourselves.
We continue to see so much focus on the energy sector because of the demand that we're expecting from artificial intelligence.
Yes.
Are you seeing that interest now, and what is the expectation for that business in the years to come?
Yes, the AI or the data centers are very important for the demand for electricity. And that's why the fusion is very, expected to be some potential very huge industry in the world. And so, especially in the region where the number of population is going down, like Japan, that we have to compensate the labor force lost in the near future. And so we need AI or robotics or something like that. And that kind of technology consumes a lot of huge amounts of electricity. That's why the fusion is needed for all human beings. Right?
Takaya, Taguchi, good to have you with us. Helical Fusion CEO here joining us in the Tokyo studio. We have more ahead on the Asia trade. This is Bloomberg.
One of the stocks we're going to be watching when trade opens in Japan is Nissan, as it promises to build on a better second quarter, and that's despite longer-term forecasts signaling persistent challenges for its efforts to turn around its worst crisis in decades. For more on this, let's bring in Bloomberg transport reporter Danny Lee. So, Danny, Nissan, of course, amid a very challenging restructuring at the moment. What's giving its management confidence in the outlook?
Well, Nissan did manage to surpass market expectations for this second quarter fiscal result, managing to turn a profit on this operating income. And it's that kind of confidence that it does look to the future. I think important critically, it's signaling it can sell more cars. So that's why it has maintained its annual target for selling 3.25 million vehicles in the fiscal year. But when you look at the first half, sales down in China 18%, in Japan down 17%. So there is a huge gap, frankly, right now to where it needs to get to sell as many cars in the final two quarters of the year. So that's going to be an 20% uplift. So there's a massive risk, really, and the kind of challenges that stand in Nissan's way are quite many, really, with the likes of US President Donald Trump's tariffs and supply chain challenges. But Nissan does think it's confident at this stage to look at the visibility for the coming couple of quarters. But still, it did surprise the market in recent days by signaling 275 billion yen operating income loss for the year on an annual basis. So there are still many challenges ahead, not just on the operational side, but on the financial side.
So really not surprising that they withheld that forecast for full year net income, right? But tell us a little bit about how that massive restructuring that you're talking about is going at the moment.
Well, they are making some very visible progress, and that kind of progress through selling its global headquarters for 97 billion yen. And that will help them book a very decent gain on that transaction. And that's as it works through the job cuts of around 20,000 workers, the closing down of factories as well. So it is working its way through that. And I think for Ivan Espinosa, by getting some of the most difficult stuff done out of the way, and particularly clearing the financial books, it can now look ahead to releasing several new models to refresh that stale lineup because of the strategy that is going to have to work both ways. And then hopefully with the visibility of some of the near-term challenges that all automakers are facing around the supply chain and tariffs, that it can then look ahead to a better future. But we're still in the infancy of a very difficult time for Nissan, the worst financial crisis it is indeed facing in its history.
Bloomberg Stanley Lee there with the latest on Nissan, as of course we'll be watching that stock at the open at the top of the hour. These are some of the other top corporate stories that we're following. Novo Nordisk has further increased its offer for obesity drug maker Metsera as its takeover battle with Pfizer escalates. Our source is saying that the bidding way is set to end within days, with Metsera's decision likely to come down to which firm can pay more. Pfizer initially agreed to buy Metsera for $4.9 billion in September before Novo shocked Wall Street with a higher bid. Meanwhile, Novo Nordisk and rival Eli Lilly have secured deals with the Trump administration to slash prices for their blockbuster weight loss drugs. That's in return for tariff relief and wider Medicare access. An official says the company's medicines will receive a 3-year grace period from Trump's forthcoming duties on pharmaceutical imports. Take-Two Interactive Software is further delaying the release of Grand Theft Auto 6, this time by 6 months. The video game is now set to come out in November next year. In a statement, Take-Two said it's giving its Rockstar Games team more time to finish developing the game. This is the second public delay of what's expected to be one of the most lucrative video games of all time.
Yeah, I was personally heartbroken at that news, Shery. I'm going to have to keep on waiting for GTA 6. So let's take a look ahead to what the Open in Japan is going to bring. Futures suggesting that yesterday's rally not going to continue, currently weaker by about 1.4%. Here in Australia, though, the market's just turned flat after a somewhat sluggish start. S&P futures better by 0.25%. We do have market opens in Seoul and Tokyo next. This is Bloomberg.
This is the Asia trade. We're counting down to Asia's major market opens and potential volatility across the Asian session. Paul, of course, we had Wall Street under pressure overnight with those high valuation tech stocks resuming those losses. We have more private indicators that the job market in the U.S. might be cooling.
Yeah, exactly. As that shutdown, though, enters day 37, we're a bit short on official data, but as you say, those job market reductions, the steepest we've seen in 22 years, also the highest number of year-to-date reductions since the pandemic as well. So perhaps some signs that the labour market and maybe consumption as well in the US might be getting a little bit weak.
I can't believe that you're actually keeping count on the shutdown days, because I'm losing count at the moment. We have so much data across Asia as well. We do have China trade numbers that are coming later today, and do watch out for the Japanese market, which rose in the previous session for the first time in 2 or 3. And right now we're seeing the resumption of losses, and especially do watch out for the auto sector, given that we had Nissan beating on operating income, but you know the challenges that the company is facing right now. And we saw Toyota also disappointing on their forecast. So that's one sector that we're watching in Japan. And the yen a little bit supported given that risk-off move, but we're still at around the 153 level against the U.S. dollar. The 10-year yield also holding at that 167 level after that weaker than expected demand that we saw on the 10-year auction earlier in the week. Take a look at how Korea is also coming online, because those high-flying tech stocks are the ones that we're watching, the likes of SK Hynix, Samsung as well. We had seen a little bit of gains for the Kospi in the previous session, but we actually had the Korean won under pressure. You can see there 1448 is the level right now because foreign investors are still selling South Korean stocks. So we're seeing the pressure on the currency space. And we are watching Korean yields as well because we had higher than expected inflation data this week, Paul.
Yeah, let's take a look at how bonds are tracking at the moment. Not a lot of change to the US 10-year at the moment. Still pretty parked where it was at the close of the US session at 4.08. We did hear from the Fed's John Williams as well, sort of debating where the bond market is versus where the neutral rate is as well, suggesting that maybe the bond market's pricing the R-star a little bit higher than where it should be. But of course, with not a lot of data to go on at the moment as that shutdown does get into its 37th day, and yes, I am keeping count because we're at a record now. There's not a lot of data to go on to suggest where things are at. Now, on that subject, we did get these numbers on US companies announcing the most job cuts in 22 years, 153,000. We've heard some remarks from Fed speakers on the whole inflation versus labour debate. Let's take a listen.
I remain concerned about high inflation and believe policy should be leaning against it. After last week's meeting, I see monetary policy as barely restrictive, if at all, and it's not obvious to me that monetary policy should do more at this time.
It is suggesting much higher R-stars, but I would discount that a bit because they've tended not to be reliable. And importantly, and this is where I just remind us, even if R-star is higher, it doesn't mean the concerns about the lower bound should completely vanish from our kind of thinking.
All right, labour market worries top of mind for investors with that fresh private data showing US companies announced the most job cuts in October. As I said, that's the most in 2 decades. Now, these cuts are being driven by a number of factors, the adoption of AI, as well as softer consumer and corporate spending as well. Let's get now to our chief correspondent for FX and rates, Ruth Carson, and Asia Markets executive editor Paul Dobson. So, Paul, I want to start with you and these private jobs numbers that we have. I mean, in the absence of official data, how much weight should we be given to these sorts of numbers?
Good morning, Paul. That's an interesting one and a difficult dilemma for everybody, isn't it? Because normally, the market gives them a, passing glance maybe, but pays much more attention to the more official numbers. But this is all we've got to go on. And you're hearing from the Fed speakers, they're not very happy about the fact that they don't have that much data visibility. But I think that what you've got here is that sort of dynamic where the only numbers that we have to go on are showing that the labour market is in trouble, but all the Fed speakers are telling us they're more worried about inflation than they are about the labour market. So although we moved a little bit in treasuries to price in the more likelihood of a December cut, it's not by any means nailed on because the Fed is basically telling us, this is not very clear at all and they could do with a little bit more data. And I think that that's why equity markets are finding it very hard at the moment to kind of cope with the lack of information that they're getting and the message that they're getting from the Fed at the same time.
The lack of information also impacting Japanese officials. We heard from the currency chief, Mimura-san, Ruth, about the Japanese yen and the difficulty there when he was talking about the deviation from U.S.-Japan rate differentials. Where are investors seeing the currency going from here, given what we mentioned about the dearth of data?
Absolutely. And we all know that rate differentials really matter when it comes to pricing currency pairs. But that said, what we're seeing at the moment is investors really debating and tussling with the idea of, is the Bank of Japan raising interest rates quickly and fast enough? And that's why we're seeing dollar yen sort of going from 152 to 155 on any given day. And we will continue to see pressure as investors debate that.
Also, Ruth, in China, we've seen extraordinary demand for dollar bonds out of Beijing. And, what's driving this demand at the moment?
Absolutely. Talk about, a blockbuster sale here. It's been incredible, and it kind of shows investors' interest in China bonds, China debt, especially in a very hard currency. And it also kind of is interesting to see where the demand is coming from. It's from sovereign wealth funds, insurers, and from investors across the globe. So it kind of shows that the debate on China, trade war or no, there's still a lot of healthy demand here for the nation's debt.
It's not only healthy demand for Chinese dollar bonds, right, Paul? Because we're also seeing global demand for all bonds, whether it's from financial institutions, whether it's from governments in order to finance their budget deficits. What's going on?
Still strong. I think it's a demand and supply thing as much as anything else. So in the same breath almost that we heard from Double Line talking overnight about worries about funding for AI data centers, they also said fundamentally there's loads of cash still available in the bond markets for credit, for government bonds, for, junk and high yields as well. What they're saying is basically this year, although we've seen a lot of supply on a gross basis, the net basis has not been all that much. People have been refunding maturing debt rather than taking on new borrowing. And so that's why you see those credit spreads incredibly tight at the moment and hungry demand for everything that's coming to the market at the moment. We hit a record for annual sales just this week, and there's still plenty more supply coming through because people know that this is a brilliant opportunity to be raising funding because the demand is still out there in the market for, I think, not just for bonds and not just for sort of looking for capital gains, but also just people who want revenue, people who want steady returns and yield are really mopping up these securities.
Ruth, we've got global bond sales at a record high as well. When you see a debt binge like this, what's it signaling to markets?
I would echo everything that Paul has said here. There is incredibly healthy demand for bonds in general, for sovereign bonds, for credit, and that's reflected in spreads that we're seeing. And in a way, there are many tailwinds. We all know that debt subordination is very real. So debt, bonds in general are a safer asset than equities, which we know valuations are incredibly high. And we've also got the Federal Reserve cutting rates. So definitely the stars are lining there up for bond investors, and we are reflecting that in the demand, the sales, and spreads.
Ruth, but what's happening in Japan? Because we had that weaker than expected 10-year JGB auction earlier in the week as well.
Yeah, again, that's a great question. So JGBs are very interesting. Every day when I talk to traders and investors, it does come up in conversation. And again, it comes back to the debate on whether the Bank of Japan is raising interest rates quickly enough. And so, absolutely, JGBs are at the crosshair here when it comes to whether or not investors buy them. And we shall have to see how that plays out in the coming months.
Paul, we've seen Chinese tech stocks having a moment as well. What's the outlook for them in this environment?
Yeah, Paul, I think that the more that we see this narrative of sort of separation between the US and China, the more it seems to play in favour for the Chinese domestic technology stocks. So yesterday there were some stories about China not wanting to use US chips in its government databases. And of course, we saw a big jump in Cambricon and the associated companies in China. But, ever since the DeepSeek moment that we had earlier on this year, Chinese tech has been on a really good, strong story. I would say that it's more than that right at this moment in time. I would say that since we had the trade talks and the truce between Xi and Donald Trump, and after that we had the more details about the next 5-year plan and the support for the industrial economy for new domestic drivers in the economy. China's markets have been looking pretty resilient. You've seen lots of volatility this week in the US and global markets, but China holding up much better than that. And in the government bond space as well, we've seen that strong demand. In the FX space, the yuan is looking resilient as well. So China really at the moment is looking like it's in a bit of an investment sweet spot, really kind of like showing that strength even as it sort of separates more from the US.
Yeah, Paul, just stepping back a little bit, is that still the case for U.S. markets? Because as we continue to see these comments about stretched valuations, especially when it comes to high-flying tech stocks, we've heard from more Wall Street CEOs, whether it's the Goldman Sachs or Morgan Stanley's Ted Pick, for example, talking about the fact that a correction would actually be healthy. Are we headed there?
I don't know that we're headed for anything particularly deep at this moment in time, Shery. Based just on the evidence that we've seen this week and recently, every time we've had a hiccup or a worry, we've seen those dip buyers come back in strongly. You've got this kind of difference of opinion right now. There's a lot of people that really believe in this AI boom, in this revolutionary technology, in the potential for those companies to carry on going. And they keep on jumping onto the bandwagon. They want to find those opportunities to come in, even though we're worried about a lot of the wobbles in the situation and the bubble risks are kind of building. And it doesn't seem like there's anything at the moment to really prick that bubble. We've got NVIDIA earnings, I think, coming up in a couple of weeks' time, so that might be something for us to watch out on the horizon. But this is the time of year typically when stocks perform well, so it might not be the time to be particularly worried that a big drawdown is coming.
Yeah, might we see that holiday bump, right? Paul Dobson, also Ruth Carson, really good catching up with both of you. Thank you so much for that. As we continue to watch the Japanese markets right now, especially, as I mentioned earlier, the auto sector, because we had Nissan, for example, beating on their operating profit, on their operating income, but at the same time, they didn't necessarily provide that full year guidance given the challenges that they face, the restructuring, the U.S. tariffs, the impact of China's restrictions on exports of some chips that they use. But also, we're watching for Honda. We are going to get their results. They could see their profit dropping as well. Remember the 15% tariffs in the U.S., of course, in place, and also coming after Toyota disappointed with their profit guidance. We have more ahead. This is Bloomberg.
China is reporting trade data later today, with both exports and imports expected to grow at a much slower pace on year compared to the previous month. Let's get to our China correspondent, Min Min Lo now. So Min Min, seems like the strong upside surprise we got last month not really going to be sustainable.
Yeah, we are looking at export and import both expected to fall below 3% on year this October compared to 7 or 8% or so that we got last month. A big part of it was because of a high base last year. Last October was the highest export print that we got in more than 2 years, 12% last October, because there was a lot of front loading that began at that time just ahead of the elections, a lot of anticipation that Trump might be causing a lot of chaos to trade flows. But right now, it seems like that momentum is slowing down, especially as we see President Xi and Trump meeting last month, the dialing down of tensions, perhaps overseas importers of Chinese goods also taking a little bit of a pause here when it comes to buying Chinese goods. At the same time, there's also the Golden Week holiday. Don't forget about that. So that's a bit of seasonal disruption to those numbers as well. Import data also looking weak, expected to grow by just over 2% on year. And again, it reflects that weak domestic demand despite the government's effort to boost spending so far. That really hasn't been effective, at least not enough to show a strengthening of those numbers.
I mean, could Beijing get some relief by the fact that the U.S.-China trade deal at least seems to be on track?
Yeah, that certainly seems to be on track. We have seen pretty swift follow-through in terms of actions taken by both China and the U.S. The U.S. has been removing that fentanyl-related tariffs or lowering that tariff by 10%, and China has also removed the agricultural goods tariffs on U.S. goods. It has removed a number of U.S. companies from its entity list as well. But it looks like China is still looking to now strengthen trade ties and investment ties with other countries, because Chinese investments are still facing a lot of restrictions in the US, and the Commerce Ministry was saying yesterday that they are open to renegotiate trade and economic deals with the EU, including an investment pact that had been put on ice back in 2021 over differences and accusations that the EU had made about China's human rights record. So interesting timing for both sides to revive talks, as there has also been some level of dialing down of tensions between EU and China. The EU Trade Commissioner saying that both sides had established a special channel to discuss rare earths, that both sides had agreed to prioritize EU companies' applications for export licenses as well.
All right, Bloomberg's China correspondent Min Min Lo there. Here's the top global headlines we're following. The US is seeking United Nations support for a proposal to send foreign troops into Gaza. The proposed international stabilization force would work with Israel and Egypt to secure the territory and assist with rebuilding efforts after more than 2 years of war. The US mission to the UN says it has received support from the 10 elected members of the Security Council. Planned cuts to US flight capacity are set to kick off Friday morning to relieve pressure on the aviation system during the government shutdown. The Transportation Department and FAA yesterday ordered airlines to cut up to 10% of flight capacity across 40 major airports. And that's left many travellers with less than 24 hours to find out if their journey may be cancelled. Nancy Pelosi says she'll retire from Congress at the end of her term, capping nearly 4 decades in Washington. The 85-year-old California Democrat was the first woman to serve as House Speaker and led her party for almost 20 years, helping pass major laws under Presidents Obama and Biden. Her retirement leaves a vacancy in her San Francisco district and marks an end of an era for Democratic leadership. Shery.
And take a look at how European futures are trading at the moment after we saw downside pressure in the last session. And it's really that narrative of potentially overstretched valuations on those high-flying tech stocks. Legrand, for example, fell 12% as demand for data center infrastructure started to slow down. Take a look at how the euro is trading at the moment. 115 is the level, but is the pound that we were watching against the euro, which weakened after the Bank of England's rate decision. They decided to hold rates at 4%, but it was a very tight vote. We're talking about 5 members voting to leave policy unchanged and 4 calling for a rate cut to 3.75%. So this sort of setting the decision up for the month of December, where we could potentially see a move. And the meeting minutes showing that BOE Governor Andrew Bailey, in fact, was the most dovish of the officials who voted to hold rates. He told us that monetary policy still remains restrictive for the moment.
Now, in August, I would say I was concerned more on the upside risk. But I think the news that we've had subsequent to that has left me in a more balanced position. So that was very much my view. But as I've said a number of times, we do need to see more evidence, because so far we've had one inflation number that's come in, under what we thought, which is obviously good. We need to see some more.
So what would sway you actually for December? And when you say that it was balanced, does it mean that one extra data point would have made you want to cut?
By December, we'll actually have 2, because we have 2 months worth of data between now and our December decision. So we'll have 2 sets of inflation numbers, 2 sets of labour market numbers, 2 sets of most other numbers as well. So that will be important. Now, I think the conditions at the moment suggest that policy remains restrictive. We've passed peak restriction, I think, but that's not surprising. We've been cutting rates, so no surprise there. That's what we intended. But I think it remains restrictive for the moment.
Governor, you've also said that decisions become closer calls as we near the end of the easing cycle. Does that mean that we could have bigger pauses in between cuts than we currently have?
Well, I think that really depends, of course, on how conditions evolve. I think the point we're making there is obviously the nearer you get to wherever this sort of neutral rate is, you're going to be slowing you've got to land the thing actually in that sense. I think that's the point we're really making. So, as we come down the sort of the path, you would expect some, we've got to land it. Hope.
So longer pauses.
Well, at some point, you'd like to think, obviously, we're in a sort of neutral condition, as it were. I mean, that will always depend upon the shocks that we're seeing, of course, around us as to how those evolve. But you'd like to think we'll get to that point. I'd like to think we'll get to that point.
Governor, I know the BOE doesn't assume anything about the budget, and of course you take fiscal policy as read when it's set out in the budget. But as Governor, what would you like to see most in terms of broad fiscal impulse from the Chancellor?
Oh, well, I'm going to wait for the Chancellor to announce it on the 26th of this month.
How would you describe your working relationship with the Chancellor?
Oh, very good. Very good. We talk quite often. It's a good relationship.
Right, just a quick final question. Nigel Farage told us, speaking about you, that this is a quote, he's had a good run, we might find someone new. What do you say to that?
Well, I made a commitment to serve out my whole term. That's what I intend to do, and there's no desire to change. It was a very cordial meeting we had. You may have seen the letter that I wrote following the letter that Richard Tice wrote to me. I wrote quite a long letter back explaining particularly these two issues, QT and interest on reserves. There are some differences of view, but we had a very cordial meeting. I intend to serve out my full term as governor.
That's Bank of England Governor Andrew Bailey speaking there with Bloomberg's Francine Lacroix. Let's take a look at how some of the major currency pairs are tracking at the moment. Dollar strength has been a theme. We've been looking at testing the 200-day moving average. However, that has pulled back a little recently. We do have the yen gaining very slightly against the dollar overnight. It's 152.97, just bubbling above that 153 handle now. This is after the US currency and Treasury yields slid. Reason being, private sector readings about the US economy. Of course, we still don't have any official data at the moment due to the US shutdown dragging on, but there was evidence of the jobs market cooling in the United States, and we've seen a little bit of strength or weakness in the US dollar as a result, and a bit of strength in the yen. Still some conversations in Japan at the moment about the possibility of intervention. We have seen some jawboning, certainly, from the finance minister and top currency officials as well. Nice boring currency there on the right of your screen, the Aussie dollar. Very little change there. We're at 64.81 at the moment. More ahead on the Asia trade. This is Bloomberg.
One of the 8 wars that we ended in 8 months. At that time, 8 months, we're looking to end one more, if that's possible. Russia and Ukraine. We haven't gotten there yet, but I think we've made a lot of progress. As I said at the time, that historic accord includes the construction of the new Trump route. It's such a beautiful thing. They named it after me. I really appreciate it. It's actually a big deal. But it's the new Trump route for international peace. This is a road that's being carved and goes through some of the most important places anywhere in the world, some of the most important places economically also anywhere in the world, which will boost commercial activity on the other side of the Caspian Sea, helping nations throughout Central Asia. I'm optimistic that each of the countries here today will reap the benefits of peace if they embrace the opportunity that we've unleashed with the agreement. Some of the countries we're talking about and some of the countries represented here are going to be joining the Abraham Accords. The Abraham Accord, and that those announcements will be made over the next little while. The Abraham Accords are very sought after right now. We're going to be announcing some very important countries that are joining, and for Jared and for Steve Witkoff, we appreciate the great job you've done this evening. I'm also delighted to report that Kazakhstan has officially agreed, and that's official now, as of about 15 minutes ago. A tremendous country with a tremendous leader has officially joined the Abraham Accords. And I just want to thank you, Mr. President. It's a great honor. It's a tremendous honor to have you. Really great. Once again, I'm grateful that each of these respected leaders has made the trip to Washington, and I'm delighted to continue our conversation over dinner. We're going to have a little working dinner, short one. They've been flying a long way. It's a long flight, but we're going to have a quick but very fruitful dinner. I want to thank the media. You've covered it very fairly, and it's really a great honor to be with these incredible leaders. These are highly respected people, and there's no games. They don't play games, I want to tell you that. So maybe I'd like to ask you, Mr. President, to say a few words if you'd like, and we can go through the list of the 5, and then we'll have a little dinner, please.
Mr. President, First of all, I would like to express my sincere gratitude to you for convening this truly.
All right, so there President Trump making some remarks at the White House there. He's hosting 5 leaders of Central Asian nations, that is Kazakhstan, Uzbekistan, Kyrgyzstan, Turkmenistan and Tajikistan as well. President Trump saying that critical minerals are a crucial item on the agenda. He intends to strengthen ties in Central Asia, a region where he says there is unbelievable potential. He also signalled that Kazakhstan has just joined the Abraham Accords and mentioned that more countries will be joining soon. Okay, let's take a look at how some of the key assets we're tracking are performing at the moment. We've got S&P futures ticking higher. It wasn't a great day for US equities today because we did see US companies announcing the most job cuts for October in 22 years, 153,000. And in an environment where we're very data poor at the moment due to the US shutdown, markets really seized on that narrative, but we're seeing a modest rebound at the moment. The dollar pulled back as well, but the dollar spot index now steadying. The yield on the 10-year has just ticked up about 1 basis point from where it was in the US session. All right, let's talk a little bit about Tesla because it was an historic day today. We had an incredible pay packet announced for Elon Musk, the Tesla shareholders approving a $1 trillion pay package for the Tesla CEO. Let's get to more on this with Tesla's Outlook transport reporter Danny Lee joins us. Danny, that is an extraordinary sum of money, a record corporate package, but Elon Musk's going to have to work for it, isn't he? What are the benchmarks attached to it?
Yeah, I mean, the kind of award that has been given, one of the biggest, it's the biggest in history. Right now, Tesla's market value is $1.5 trillion, and there are several stages of milestones that Tesla has to reach, and Elon Musk has to drive in order for Tesla to get there. Eventually, ultimately getting to a market value of $8.5 trillion and an adjusted earnings of $400 billion. So that is no mean feat by any stretch, and by having to follow these kind of very tough goals, maybe he will become the first trillionaire. But behind all of this is this kind of this smokescreen, because ultimately what Elon Musk really wanted was more control over Tesla. And so by this 75% passing of this compensation plan, this will hand over Musk around 25% or more control over Tesla. And you think about the value of Tesla potentially over time on top of the $1 trillion compensation plan, it makes Musk even more wealthy. And I think critically it gives him the kind of the agenda and the mandate from the shareholders to pursue these kind of autonomous goals, artificial intelligence, robotics, and driverless robotic cars. So there's a lot there that now Musk has within his grasp that he now has to try and fulfill. You know, all the tough talk and all the campaigning over the many, many weeks and the pressure minority and individual shareholders have put on institutional shareholders, at least now that Musk has got his wish.
So how well is Tesla's business positioned right now to help Elon Musk achieve those benchmarks?
Well, clearly Musk and Tesla is going through a transition, and so he has to now deliver on some of these future-looking, very ambitious goals around artificial intelligence, robotics, and whatnot. And clearly, with the EV side of the business struggling, there is going to be a rollout of various products over the years to come. But as we have seen often from Elon Musk, there has been a lot of overselling and under-delivering. But at least ultimately, Elon Musk does deliver on these goals, whether they're a little bit later or delayed. So I think for shareholders, they will believe him and put him to his word that he will fulfill those kind of promises. Whether he actually gets to fulfilling all of the milestones to become a trillionaire, we shall wait and see in about 10 years' time.
Former transport reporter Danny Lee there with the latest on Tesla and Elon Musk's wealth. These are some of the other top corporate stories that we're tracking at the moment. Take-Two Interactive Software further delaying the release of Grand Theft Auto 6, this time by half a year. The video game is now set to come out in November next year. In a statement, Take-Two says it's giving its Rockstar Games team more time to finish developing the game. This is the second public delay of what's expected to be one of the most lucrative video games of all time. Novo Nordisk has further increased its offer for obesity drug maker Metsera as its takeover battle with Pfizer escalates. Our sources say the bidding war is set to end within days, with Metsera's decision likely to come down to which firm can pay more. Pfizer initially agreed to buy Metsera for $4.9 billion in September before Novo shocked Wall Street with a higher bid. Meanwhile, Novo Nordisk and rival Eli Lilly have secured deals with the Trump administration to slash prices for their blockbuster weight loss drugs. That's in return for tariff relief and wider Medicare access. An official says the company's medicines will receive a 3-year grace period from Trump's forthcoming duties on pharmaceutical imports. We have more ahead on the Asia trade. This is Bloomberg. Take a look at the picture ahead of the Chinese market opens. The offshore yuan holding at that 712 level. We had seen a little bit of support after the downside that we saw on the greenback on the other side of the trade. We're also watching for export numbers out of China today, likely slowing down in the month of October. Remember, those shipments to the U.S. might have taken a hit given, of course, the tensions over tariffs. But it seems that the trade deal between Presidents Trump and Xi Jinping are on track. The Chinese Ministry of Commerce now saying that China is willing to work with the U.S. and implement those goals. In fact, the U.S.-China Business Council saying that there's cautious optimism among American and Chinese firms a week after Presidents Trump and Xi struck that trade truce. We spoke to Council President Sean Stein at the International Import Expo in Shanghai and asked if commercial ties are showing signs of recovery.
It has absolutely been bogged down. And American companies have been very much on tenterhooks, wondering which way things are going to go. What I think is interesting is after Korea, the Chinese government has already tried to send out signals that we welcome American business and we want you to be here. I mean, case in point, we're at their giant, import expo. We have more American companies here than at probably any other trade show in the world. And last night, the Chinese premier comes, and who does he visit? He visits 3 American medical companies, sending a really strong message that, hey, we value you and we value your investment. So the Chinese side is trying to reassure American business. But American business, while they see the deal that happened in Korea as the best possible outcome, there's a question about, is it going to last?
Right. How long will it last?
Well, we've seen this movie before, right?
Yeah.
2 days after Geneva. Geneva lasted 48 hours before it melted down. And I think Madrid lasted about 10 days before we started to have real problems. And so while there's hope that this time it'll continue, there's still going to be a lot of guarded, cautious optimism, at least until April.
Not asking you to take a political position here, but do you think in Washington they underestimated China's position and levers of strength that they could possibly employ going into this trade war?
I think there were 2 problems. I think one problem is I think the United States may have overestimated its leverage and how worried China would be about U.S. tariffs. And I think they underestimated China's counter leverage.
Right.
But at the same time, both sides have the ability to do enormous damage to the other's economy through export controls and other measures. And I do think that both sides have sort of looked over the abyss and said, maybe that's not where we want to go. And so both sides have realized, yeah, now's the time we can pull back. The question is, can we stay pulled back? Or are we going to get into another escalatory spiral?
What are you seeing internally in America against the backdrop of these national policies? Are you tangibly seeing regional blocs looking for their avenues into China? I'm not necessarily saying trade deals from the Pacific Northwest. Say, for example, Washington state officials are here, Oregon state officials are here. Look what's happening in the Midwest with those soybean farmers maybe feeling they're not getting their voice heard. Are you seeing sort of regional blocs talking to the Chinese officials, talking to the Chinese companies, and trying to get some sort of favorable deals for themselves?
Okay, let's not name names, but I'm seeing some nervous governors. 800,000 jobs depended on trade with China. And those jobs are starting to go away because U.S. exports to China and U.S. exports to other regions are going away because of high tariffs in the United States. And so I'm hearing about nervous governors who are asking us, how long is this going to go on and where's the light at the end of the tunnel? I'm hearing it from members of Congress on both sides. So I think that, yes, We're not at the point where I think we're seeing regional blocks, but I do think we're seeing governors starting to think about how can I continue and protect the jobs that we have that are tied to exports to China.
Last question for you on the high tech. Obviously, Donald Trump was talking about possibly putting Blackwell chips on the table. I think maybe his more national security hawks in D.C. convinced him otherwise. But how do you see China's leverage increase tremendously through the DeepSeek moment and its confidence in AI to the point where they don't necessarily need that chip?
I think you hit that on the nose. And that is, my job was negotiating with China for a number of years when I was at the State Department. And you would get a long list of issues that were unresolved. And the issue wasn't, say, if we had 15 issues that were unresolved, the issue wasn't to resolve those 15 issues. The issue was to find the 3 they really cared about. The rest were bones that they would throw at us to chew on. I think that right now, Chinese companies, they want access to chips. The Chinese government, not so much. And so I think this is one of the bones they've given us to chew on, where do I think it's good for the U.S. economy to sell more chips here? Absolutely. Do I think this is keeping China up at night, that they're not getting Blackwell chips? Yeah, probably not. And the most important thing is the way they talk about it. When I talk to Chinese businesses, entrepreneurs, academics, scholars, and most importantly, people in the government, and if you ask the question, who's winning on AI, they give this look like, what does this mean? What is this winning of which you speak? And they don't see it in those terms. What they see is, they see not a race to AGI, they see a race to deploy AI into every business, every school, and every sector of the economy. And what I see are companies, whether they're Chinese or foreign, racing and pushing AI out into every aspect of their business operation. And I think in the minds of the Chinese, that's the goal with AI, is to push it out and drive efficiency.
It's US-China Business Council President Sean Stein speaking with our chief North Asia correspondent Stephen Engel in Shanghai. Well, let's turn back to markets. We are counting down, of course, to the start of trade in China and Hong Kong. And China's value trade is signalling a comeback after spending much of the year on the sidelines as AI stocks have dominated investor attention. Catherine Ngai, who leads our Asia stocks coverage, joins us now. So, Catherine, what's driving this change?
Right. So I think that, as long as we continue to talk about AI, it's clear that now that we're kind of a year into, the start when we were, with I'm going to call it the beginning of this year with DeepSeek, that investors are trying to find winners and losers. And on top of that, investors are also trying to find places where it's still cheap, and the AI trade has gotten quite expensive this year. And so we're seeing that for the first time since 2022 on a quarterly basis, that the sort of value trade is actually outperforming growth. And part of that is, yes, AI is really expensive. Part of that is also the Chinese government, supporting the local economy and long-term investors thinking that maybe there's, some buying room in the defensive space.
That's really interesting, right? Because earlier in the year, as we got started, January, February, we saw that excitement over DeepSeek. Does that mean that AI stocks are out of vogue in China, or what are the risks of this value bet?
Right. I think it really is kind of a play right now where people are trying to find the winners and losers. I mean, it's not as though, it's not so one-to-one, black and white, tech is out, value is in, or growth is out, value is in. But people are trying to find selective names, and people are trying to be a little bit more selective because things are expensive. I mean, this is great, right? Like, this is, you want people to sort of rotate. You don't want the sort of broad rally just in one sector. You don't want that one sector to overheat. I mean, that's got problems sort of on a more broad level. To the sustainability of the market. So in many ways, I mean, a rotation kind of like this is supposed to be, better for sustainability. But it's also interesting because we have another story out today talking about sort of the pair trade between Alibaba and Meituan, and how we've really seen sort of a tale of two tech giants here, with Alibaba, really strong this year, and Meituan being kind of a short target. If you just kind of see that gap between these two stocks.
All right, Bloomberg's Catherine Ngai there in Hong Kong. Let's take a look at how commodities are performing at the moment, in particular oil. Of course, we have had OPEC Plus raising production by, well, it turns out 50,000 barrels a day back in October. Key members slowly restarting another layer of halted supply. But there's other factors at play here as well. Oil really extending those declines after Saudi Arabia lowered prices of its crude, so that signals even more uncertainty around the supply outlook. That price of its main oil grade to Asia for December now at its lowest in 11 months. Traders seeing that as a bearish signal about the cartel's confidence in the market. And the US benchmark has also slid as increased output from OPEC Plus and non-member nations as well just keeps on amplifying these concerns about a global glut in the oil market. So there we have Brent crude right there at $63.38. Gold still holding on just below $4,000 an ounce. We've got more ahead on the Asia trade. This is Bloomberg.
Malaysia's Deputy Prime Minister says Chinese trade has been more friendly. Ahmad Zahid Hamidi spoke to Bloomberg on the sidelines of the China International Import Expo about how Malaysia is navigating its ties with both Beijing and Washington.
Centrality has played an important role, not only in terms of diplomatic relationship, but also in terms of trade and G2G, as well as B2B and P2P. And to us, as we move forward, right from last year, 2024, until 2028, we are ushering in new golden era where one defined by innovation, sustainability, and also high-quality growth has been coordinated by Ministry of International Trade and Investment. And it is well coordinated by other ministries as well.
Does it complicate matters with China because of the trade agreement that was reached with the Trump administration just in October when Donald Trump visited Malaysia? There's been some, of course, concern in Malaysia about that, but what kind of overtures need to be made to China?
What we are doing is to have and to create understanding. What is important is the chemistry between China and Malaysia has been created for many decades. And we are merely translating all this commitment into action. And then the Chinese traders normally is more friendly. They understood the multiculturalism that we embrace, as well as cross-cultural communication that we are having with the Chinese traders.
Has China issued any kind of concern about the deal that was?
Yes, they have been working with our state's government. We have 14 different states in Malaysia. Yeah. And basically, the raw materials is under the control of the states. And the federal government is coordinating with the state. That is why we impose on the semi-finished product to be exported.
Can I ask you a domestic question a little bit about, obviously, the trade minister's portfolio is going to be gone from the other party by December, I believe, as Zafrul Aziz will step down. Is that the portfolio, the trade portfolio is so important to Malaysia, as we've just been discussing? Is that something that you'd be working to get back into the fold of UMNO?
We have many talents within UMNO leaderships. But, the appointment of ministers, deputy ministers is under sole prerogative of the Prime Minister. We will obey to his choice, but we would like to propose that some of experienced ministers from UMNO can continue the good work done by Tengku Zafrul in MITI.
That's Malaysia's Deputy Prime Minister Ahmad Zahid Hamidi speaking to our Chief North Asia correspondent Stephen Engel. Here are some of the top corporate stories that we're tracking. Huawei is taking direct aim at Apple's iPhone Air with a new product called the Mate 70 Air. The handset is just 6.6 millimeters thick, priced at about $590. That's compared with $999 for the Apple product. China's smartphone makers are showing a greater willingness to confront Apple, with Xiaomi rebranding its flagship lineup as the 17 and 17 Pro. OCBC has posted higher than expected quarterly profit as strong wealth management fees helped offset the decline in lending income. Net income for Singapore's second largest bank was just over $1.5 billion. Trading income rose alongside wealth management fees as OCBC joins bigger rival DBS in benefiting from strong money flows from the rich. Shery.
Broad downside across markets in Asia, really being let down by those tech stocks, and following the downtrend from the Wall Street session. Of course, those high valuation stocks under pressure right now as there are more concerns about the U.S. labor market. Do watch out also for Chinese trade data later today. That's it from the Asia Trade. Our markets coverage continues. The China show is next. This is Bloomberg.